Welcome to CrushTheStreet.com's weekly market wrap-up. We'll start things off in the equity sector, which initially traded up on Thursday morning as a sort of mini dead cat bounce, but ultimately the efforts proved to be futile as only the S&P 500 posted gains, if you can call a 0.02% move up a gain. Various mainstream analysts have noted that this so-called rally has been a disappointment, and a retest of prior lows for the major indexes could be looming on the horizon. Perhaps the biggest shocker that wasn't quite that much of a shock was Standard & Poor's reduction of Spain's credit rating to one notch above junk grade. While the actual announcement may have caught some traders off guard, and although some rumblings did occur in the Forex markets, much of the volatility balanced out by Thursday morning, with the US dollar closing at 79.78 and the euro recovering the 129 level. Currencies will be a major talking point moving forward, especially with those who have an eye towards the commodities sector. If we look at the technical charts for the US dollar index, we can see that the paper bulls did gain some momentum this week, as the last three sessions price action occurred mostly to the north of the 20-day moving average. It does have to be noted that the dollar bears do have control of the market, although continued uncertainties in the Eurozone could give strength to the greenback, as it is seen as the least worst currency. Now, how will all of this affect gold in the coming weeks? As you know, it's been a month since QE3 was announced, and the price of gold has basically gone nowhere. It attempted a shot at 1800 and it tested 1750, and the damn price keeps nestling in at 1770, giving neither the bulls nor the bears any meaningful chance of profitable trading opportunities. My biggest concern here is the incredibly lethargic price action, given that nearly all major economic powers have introduced some form of monetary easing. Since the beginning of this week, the overall trend has been decidedly downwards, with the last two sessions trading range occurring mostly underneath the 20-day moving average. Let's take a look at silver for a more technical examination of recent developments. First, the overall trend of this week has been down, with the last four trading sessions occurring mostly underneath the 20 DMA. Second, the last two sessions were positive, but this upward movement is diverging against the declining trend found in the volume and the MACD. Traders are especially leery about rising prices occurring under declining volume, as it suggests both that the higher prices cannot be sustained and that the bulls are getting tired. Finally, I'd like you all to consider a recent article from optionsmonster.com entitled "What's Behind Put Action in Silver?" For new investors, a put involves purchasing the right but not the obligation to sell an asset at a designated price. When a big player purchases a put, it's generally considered bearish, as there is an indication of a downward movement ahead that needs to be hedged. Will we get lower prices? A lot depends on the US dollar index and whether investor fears of a Eurozone meltdown continue to pour strength into the greenback, which is bearish for commodities and precious metals. The upside potential is that risk-off safe haven demand actually moves into gold and silver first instead of fiat currencies. However, we do have to keep in mind that technical indicators are weak for the metals, and recent fundamentals haven't done much to help their cause. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.